Hello and welcome everybody. Welcome to our webinar, the 80 billion question, how will the new IRS affect you? So whether you're our PTS client already or friends of ours watching on YouTube or LinkedIn, we're really glad you're here. Thank you for sharing some of your day with us. I would like to make some introductions. I'm Angie O'Day. I'm the Client Success Manager here and would work alongside you if you were to choose to onboard with us later down the road. Then we also have David Auer, the founder and president of our firm. So going into our agenda, we've got some great content to cover today. First, we're going to go over the overview of the Inflation Reduction Act of 2022, IRS Audit Statistics, IRS red flags, and last but certainly not least, the next steps.
So welcome everyone. So this is David Auer. Just like to start off with a typical disclaimer. Everything we're providing here in terms of suggestions or advice is certainly not intended to result in anyone having to pay unnecessary taxes or penalties. So we'd recommend that you seek competent advice on anything that you might hear in this webinar. The first item we'd like to talk about is just an overview of the Inflation Reduction Act, 2022. For those who have been seeing this in the news, you may have seen that it initially passed the House of Representatives with a small margin of victory. There was no Republican support for this bill in the House. The Senate then had to pass it by using all of the 50 Democratic votes in order to get it through the Senate. And then the president signed the bill on August the 16th. The act is expected, or the bill is expected to raise $737 billion in revenue over the course of the next 10 years, require about $437 billion in investments, and reduce the deficit by about $400 billion. However, there's some debate about whether or not it will actually reduce inflation based on a couple of studies that have been done over the last several months. So major provisions in this act. We won't go into all of them in detail, but just at a very high level, the first four of them, which is it creates a new 15% corporate minimum tax rate that it applies to large corporations. There is a fairly sizable amount of reform in the prescription drug pricing rules. Also extends the Affordable Care Act subsidy. And then there's numerous new and extended energy security and climate change investments. The one we will focus on today is the provision that deals with the IRS tax enforcement and the funding that's going to go beyond it. So when we look at the funding and break that down into how much of this potential $80 billion is going into what area or what category under the IRS's structure. We start with the largest being that $45 billion is going to go toward enforcement. And I'll go into a little bit more detail about that later. Operations will receive about $25 billion. Modernizing the business systems, the computer systems that the IRS relies on is going to be about $4.8 billion. Taxpayer services, which is really the people that answer the phone and respond to your questions, is going to receive about $3.2 billion. And then other miscellaneous things like, rent for office buildings to staff everyone, that's going to be estimated about $0.7 billion. So when we look at what this looks like in perspective, the funding compared to what the average expenditures by the IRS or what the funding the IRS receives over the last 10 years, what you can see here on this chart is that the enforcement has been allocated about $66 billion a year on average for enforcement. That's going to increase by about 69%. So that's where we're going to see a fairly sizable increase in individuals that are going to be out there on the front lines on audits and appeals. We're going to have about a 53% increase in operation support, where business systems modernizations, they're getting not necessarily the largest dollar amount, but they are getting the largest percentage increase from what historically they've had. And just from what we understand, the IRS is still operating on some very antiquated computer systems and programming dating all the way back to the days when COBOL and Fortran were being programmed. So there's a significant amount of technology enhancements that will also be made just to make the computer systems operate a lot more efficiently. And then taxpayer services will get a small bump of about 9%. Although that is an area where there's really been a deficit. If anyone's had had the experience being on hold, waiting on a phone call to have their question answered, this is going to be an area that I believe, and what I've read is this will be one of the first areas where some of this investment is going to be made just to get enough people hired to be able to answer the phone. Technology will also probably happen on the early stage just to get the computer systems up going. It's probably going to take several years to not only hire or recruit and hire and train the people who are going to be in operations and enforcement, but that'll eventually get up to speed and obviously hopefully allow the service to catch up on where they've fallen behind in the past several years from being able to during COVID and before COVID. So let's look at some IRS audit statistics, because one of the biggest alarms that you hear in the media is how much more how much higher the risk of audits are going to be going up for people. But I think to put that in context, I think we really have to look at how who gets audited and at what levels of income really where the risk of an audit is. So if you look at this information, and so this is just the most recent year that the IRS has published this information is, and this comes out of the House Ways and Means Committee in May of this year. But what you can see here is the number of tax returns that were filed per income level, and this is only for individuals, based on certain income levels. So as you can see, the highest number of returns is in the lowest income bracket of under $25,000. And those numbers of returns just gradually drop in number the higher the income level goes. You can also see next to that is what are the number of audits that have already been started for the year 2019. And then probably more importantly, as you shift to the right and you group some of these income levels together into broader ranges, what you can see is that 0.4% of those returns of under 25,000 are being audited. Only 0.2% of taxpayers that have between $25,000 and $500,000 of taxable income were audited. The number then jumps fairly significantly once you're above 500,000 up to the 5 million, and then it jumps again pretty significantly for those with $5 million or more of income. So you can see that the audit rate percentage generally tracks and increases proportionally as income is going up. So let's look at that over time, how that has changed. Because if we go back to the year 2010, if there were a significant number of tax returns that were actually getting audited if they had showed losses. Now, keep in mind that the year 2010 was right after the last Great Recession. So there were a lot of individuals and businesses that were showing losses on tax returns. And so those naturally received a significant, resulted in a number of different audits, or a pretty big percent. That number for those people who had losses dropped down to 6.8%, which is a 67% decline over that 7-year time period. It dropped very significantly as a percentage between 2017 and 2019. So that was a 94% change since the year 2010, and it was 83% just in the 2-year time period from 2017. As you go down this chart down to the income level, you can kind of look across and see which one you might fit into. So for example, if you're an individual making between $200,000 and $500,000 of income, you can see that back in the year 2010, there was about 2.3% of those taxpayers that got audited. And again, these numbers are not inflation adjusted, so you'd have to take that into account. By the year 2017, those individuals in the $200,000 to $500,000 range, they dropped pretty significantly down to where only 0.4 of 1% of those were getting audited in the year 2017. And that number dropped in half again in the following 2 years over 2019. So for the most part, most taxpayers have had a very significant drop in the percentage of returns that were have been audited over the last 10 years or 12 years now, if we count the most recent. So you can see here that even in the higher income levels of 100,000 plus, the percentage of individuals getting audited dropped anywhere from 27.8% for those between $1 million and $5 million, all the way up to 50% for those that were between the 100 and 500,000 and above the $10 million mark. So all in all, the occurrence of audits has dropped off dramatically over where we were where the IRS was in a position 10 or 12 years ago. So putting that in perspective and realizing that these percentages probably can't get much lower than they are if we're going to have an effective tax system. But probably at the same time, a lot of this is due to what the limitations and how the IRS itself has been, their hands have been tied over that time period. So if you look back in 2012, there were about 90,000 full-time employees employed by the IRS and all the different departments that they had. That started declining, starting in 2012, to where it reached a low watermark in about 2018 to 2019. And then slowly and this has been during COVID, is when these employees have started coming back on board and starting to increase in number. So the reality of what is going on with the state of affairs with the IRS is that prior to this Inflation Reduction Act of 2020, the IRS has experienced fairly significant difficulty in replacing their audit staff due to attrition and retirement. So that's been happening as the older employees have been retiring, and it's been more difficult for them to replace those individuals. The other thing to keep in mind, and I know many on this call will have little sympathy for this, but the reality of it is the IRS, the money that the IRS receives has been continually on the decline in real dollar terms. So today, or for the most recent budget year of 2020, their total budget was $11.9 billion, which was $200 million less than it was back 11 years before. If you take into account inflation, that's the equivalent of about $2.7 billion less, which is really about a 22% reduction in real terms. One other important fact on this slide is if you looked back at the budget in real dollars of what the IRS has to work with and their staff, they're working at about most recently they're at about the same level of funding and staff that they were back in the year 1973, which is pretty remarkable that they're even able to function at that reduced capacity. Obviously, the level of staff and burnout over the last several years, according to what we read, has been pretty tremendous too, because these people are putting in tremendously long hours just trying to catch up, and they're not even able to do that. So when we look at how the allocation of personnel are by category, and again, this is where this large investment that's going to be in enforcement is going to be made. You can see the breakdown. For example, in between 2020 and 2021, there's been a slight increase in the total number of personnel, and then you can see what that looks like both in each activity, whether that's examinations, filing, information systems, all the way down to investigations, and then who they have on their team, helping update and keep the computer systems updated. You can see that the percentage of increase, of how these dollars are allocated, about just under 40% of their budget is going into examinations and collections. You might have read in the media, there's been circulated information that there's allegedly going to be an additional 100,000 new employees hired by the IRS. That number actually comes from literature that the Treasury Department back in 2021 had projected of how many personnel it would be able to hire if there was enough funding. The reality of it is, based on the IRS's information, they're hoping to be able to hire as many as 10,000 over the next 10 years. Just most recently, a month or so ago, they announced that their goal really in the short run was to try to hire 4,000 new personnel. So the reality of it is, even though we've read about how big this bill is and how much more powerful and potentially threatening, the IRS is in increasing audits, I think what we're going to find is there's going to be a period of time where they are just catching up from where they fell behind during COVID. They're going to be trying to invest in their technology and in improving their the customer or the taxpayer experience through through support. And then what I think we'll start seeing is an uptick in the percentage of audits. A large percentage of those audits have been over the last decade been done by correspondence rather than in the field, or where you generally have an appointment to go in with your documentation. So we'll probably see a continued increase in the number of audits that are being done via mail. So let's talk about some red flags. So everyone we talk to as a CPA firm and as well as in our own practice, we put a very high emphasis on identifying and hopefully eliminating any potential what we call red flags, which are items or things that could increase the risk of an IRS audit. So what I'd like to do is introduce a list that we compiled of about 40 different red flags. There is no particular one that is, there are ones that are weighted heavier than others, but it's difficult to know without having inside information with the IRS's audit program of how they weight these and which ones get picked more than others. But as you can see from some of these are fairly obvious, some of these obvious mistakes that inadvertently result in an audit, whether it's a math mistake or the wrong name or missing social security number or missing information, which is a big one where you may not have reported, a 1099 or W-2 from everywhere. Amended returns amending your tax return will increase your risk of an audit. Plus, it also extends the statute of limitations, which I'll talk about here in a little while. Failing to report all of your taxable incomes. So there's still a large number of taxpayers that work on a cash basis, and not reporting your income is based on the research. How the IRS picks a tax return may subject someone to an audit. If you make a lot of money, obviously, as you saw the percentages, the higher your income is, the greater that percentage of an audit risk goes up. And then another area that can generally create a red flag is that if you report higher than average deductions for your income level, or taking large charitable deductions, for example. One of the hot buttons for the service, and you can see this every year where the IRS publishes their list of what they call the dirty dozen, could be purchasing and investing in a syndicated conservation easement where the value of the charitable deduction has been inflated. Generally speaking, if you run a Schedule C business, those are generally going to be a very significant increase in audit risk, just because you have a lot of numbers showing up on a Schedule C, and potentially, that's just drawing attention to whether or not those deductions are ordinary and reasonable and necessary in that business. If you are kind of don't like to be overly precise and you just put a lot of zeros on your return as estimates, that'll generally increase your risk. If you've been audited before, especially if you're on the radar screen, from prior years, that could increase your risk as well. And then an area that has become probably increasingly problematic is where you invest in real estate or rental property, and you don't meet the passive loss or passive activity number of hours, or you're not a legitimate professional, real estate professional, then that could kick out a loss, especially if you've got a lot of other income like W-2 income that you're trying to offset those rental losses into. And then obviously, if you don't file a tax return on a consistent basis, that could get you audited as well. So I have another or a further list here. You can look at this list when you receive a copy of this, or if you're viewing this after this presentation. You can see which ones of these generally could pick out or increase your risk of an audit. So you just have to be very careful if you are going to be deducting any of these or taking credits for any of these items, that you make sure you're staying within the boundaries of what the law allows, and that you probably most importantly have very good documentation and record keeping. So as you can see, then there's additional risk if you do anything offshore, if you take too large of home office deductions, or meals and entertainment expenses, or if you are attempting to write off your losses as a day trader of some kind of investments. That could also get you in trouble. And then the last one there on the list is you just recently made the Dirty Dozen list, which is abusive micro-captive or closely held captive insurance companies. So those are all the red flags that we were able to compile, that the IRS over the last several years has been identifying. Again, working with a proactive tax planning or CPA firm should allow you to know what the potential red flags you do have, and how to best protect yourself. So if you're engaged in any of these possible transactions, make sure that you're working with somebody who can truly educate you on what the rules are, and the record keeping rules, and what is legal and not legal to take advantage of. So as far as how far back to keep records, and then also your tax returns to the extent that they can be audited. So as a general rule, the IRS can audit your tax return for up to 3 years after the date of filing, unless one of the exceptions apply. So the first exception is that if in the year that they audit and examine your return, if your adjusted taxable income increases by more than 25%, that allows the IRS to go back as many as 6 years to audit your tax return. So again, as you're assessing audit risk and the dollar and quantify what that audit risk could be from a worst case scenario, just make sure you're aware that could open up a number of other years for the IRS to be able to examine those returns. So record keeping becomes very important, especially if you're taking large deductions, to keep those records going back at least 6 or 7 years. If you don't file a return, keep in mind that the statute of limitations never starts, because basically the IRS hasn't had an opportunity to audit something that hasn't been filed. So if you haven't filed, and you're concerned about the risk of an audit, the safe thing to do would be make sure you file, or go ahead and file their tax return, and at least get the statute of limitations to start running. And then the last exception is there is no statute of limitation if there's been a fraudulent income tax return filed, and that burden of proof is on the IRS to prove that. But that would open up an unlimited number of years. Another concern that you should have is if you are deducting losses for a business consecutively year after year, you run the risk that business is deemed to be a hobby and not a business. And if the IRS audited that for 1 year, they could obviously go have the ability to say that was a loss, or that it was a hobby in all the prior years, and be able to go back to each one of those years and assess taxes and penalties and interest. So just be very careful when you are as your income goes up, and as you start engaging in more and more attempts or transactions to reduce your taxable income, just make sure that you are at the same time minimizing as many of the red flags as you can to make sure you're off the radar screen of being audited. So I'm going to turn it back to Angie, who's going to talk about the next steps.
Thank you, David. That was great. Here we have our strategic wealth system model. These 8 steps were actually created around our clients' biggest needs and are reflective of the advice given in our newest book, The Richest Doctor. We start with the tax minimization here at the bottom, moving into controlling your money, and reaching the ultimate goal of financial independence. This is our process. So we begin with our strategic tax blueprint. If you like everything that you see with your strategies on the blueprint and want to move forward with us, we would begin onboarding pretty immediately. And then we would move into implementation. So actually putting into place all of the strategies that we have shown you in your blueprint. And then lastly, and very important and unique to our firm, is the quarterly pulse. So this is where we will meet with you every quarter, making sure that we have a proactive approach in place to meet our goals and objectives for the next quarter.
And I'll just interject on the strategic blueprint. That's also where we go in and identify for a new client, what are some of those IRS audit risks that they may be subject to, and just in our recommendations, attempt to provide recommendations on how to mitigate whatever that risk might be, assuming that the client wants to continue to file or claim that deduction. We just want to make sure that they're doing it in the right way.
All right, so your next question is probably, how are you going to get started on your tax planning and implementation? Typically, the most standard way is to schedule a 30-minute introductory call with me. That will give me the opportunity to get to know you and assess your current income and tax situation. And then I can dive a little deeper into what our firm is all about and what we have to offer. But if you want to skip that part and not meet with me, you can go on right to buying the Strategic Tax Blueprint Starter Kit. So once that happens, we will begin working on your strategy pretty quickly.
And we're going to post in the chat how you might be able to schedule a introductory first call, and also the link to go directly to our website to download the Strategic Tax Blueprint Starter Kit. So Tyler, if you will, on the in the chat column, if you'll type in both how to link to schedule the introductory call with Angie, as well as how to go directly then to the Blueprint Starter Kit. And we will be sending out a copy of this presentation, and it'll be available through our various media channels, our social media channels, with these links attached as well. So,
all right. Yeah, so as I mentioned earlier, we do have our new book, The Richest Doctor. Many of you on here today have actually read it and given us great feedback and indicated that you've been very inspired. So we want to make sure that we have this offer available for those that haven't had the chance to preview or read it. So we are offering the first 2 chapters for free right now. So you can also get inspired. And we've got that link on the bottom here, therichestdoctor.com/webinar. So you can begin the process of downloading those first chapters.
Or you can just go online and get the paperback or the hardback version, whichever you'd like. Mm-hmm. I will say that these are significantly discounted prices versus if you went on Amazon and got the book on Amazon. So now I'd like to just open it up for questions. So I think Tyler in the back has been getting a couple of questions sent to us. First question is, does this investment in the IRS make them even the least bit proactive, or just help them catch up? That'll be a good question. Over the last several years, we've just seen the effect that that has happened on our clients, and what we hear from our colleagues about how far behind they're getting responses from the IRS back. So I think time will tell. I'm hoping that they make the investment in their operations and get their technology updated. They're using decades old programming still in their software, using old programs like COBOL and Fortran. So there's a lot of catching up to do on the technology side and on the customer service side, just answering the phone. So I would hope that they would spend the money early to get those things in place, and then also catch up on some of the backlog over the last several years. So the next question is the government giving the IRS money in preparation to raise taxes and make sure they collect? So I think it goes without saying that if you're going to make a significant investment in the enforcement side of the IRS, which are basically going to be the agents and the revenue officers who are going to be examining returns, I think the likelihood of the risks of audits trending back to be closer to what they were in 2010 should be expected. I don't think it'll happen overnight, but I think it could happen over the next 5 to 10 years. Just my reasonable assessment of it. I also think that the safest thing to do is always prepare your tax return as if you are going to get audited. So you can typically do research to identify what is the proper type of record keeping that you need to keep on various deductions. There's several publications available on the IRS's website if you wanted to self-educate on that. Again, like I mentioned earlier, it's very important to to also be working with a firm that knows how to help you identify what are those potential red flags and how to reduce the risk of those so that you hopefully can reduce that risk of an audit. Last question that we have here that's coming in is I've always heard that 9 out of 10 calls to the IRS go unanswered. Is that true? And do you think it'll change? Well, I certainly hope so. I think I don't know what the true statistic is. But I know that personally in our firm, we've spent hours and hours on hold, and oftentimes get disconnected and have to get put back on the list, the waiting list before our calls are answered when we're calling on behalf of a client. So I know that the IRS is aware that has been a weak spot for them, and I've read that, and again, this is not this is up to their control, but I think that they made it a priority to at least start recruiting and hiring people that can at least answer the phone and answer basic questions. So that wraps up our questions for today. Again, if you have any interest in finding out more about how we might be able to help you, we've got the information in the chat box that you can look at. I'll keep this slide open for a minute or so that you can have time to click on that link, either to go ahead and fast track getting a strategic blueprint. It was on the slide before, but I'll just remind everyone that the cost of that blueprint is $1,250. It's a one-time fee. It does come with a 10 times guarantee, meaning that if we look at all your situation and we're not unable to save you at least 10 times that amount of that fee in taxes in the first year, we refund that fee back to you. So basically, you still get our advice and our recommendations, even if we can't help save you 10 times that amount. If you like what you see in the blueprint, then we have with our recommendations, we have then a proposal of how it would what the investment would be to work with us. Generally, our goal is to achieve a 10 to 20 times multiple return on your investment for whatever it costs you to hire us to help get things done. We have what we call a membership model, so it's just a month-to-month relationship where we scope out all the work that we'd be working on over the next 12 months, and we just make that easy, to be able to afford to where that's spread out over 12 equal months. And again, if you want to get jump started with Angie, just click on the link in the chat to schedule an introductory call with her. And if you miss that link or that website to get your own copy of The Richest Doctor, there's also a link there in the chat page. Again, I want to thank everyone for joining us today. I know that these are worrisome times, especially when it looks like the IRS is going to be coming after people otherwise minding their business and staying under the radar. There will be, I think, an additional amount of media attention devoted to this over the period of time, and I would just caution you to make sure that you're reading as objective of information as possible, because there's always tends to be an exaggerated opinion that's out there that tends to worry people. Again, I thank everyone for your time today, and we look forward to talking to you soon.
Thank you, everybody.
Take care.